Hello everyone, welcome to Observer 24/7. My name is Niharika Bhatnagar and I'm with you with the specific area of ABFM. Today I'm going to talk about a specific area of the chapter leverages, that is basically module B, second chapter, right? So first of all, please share the session, like the session and subscribe to the channel if you haven't done it yet. And let's talk about it right away. We have a specific topic called operating leverage. In terms of leverages, we have three different leverages. Number one was financial. We have talked about it in the previous class, and now let's talk about the second part, that is called operating leverage. See, when you are working at your present level of operations, you might be working at 10,000, 20,000, 30,000 units production. You want to increase your production further, then you are increasing your scale of operations. In this case, you don't want to increase your production, but you want to increase your present level working in a better way. Basically, you want to work in a better way at present situation. In this case, we call it operating leverage. Operating leverage is basically the relationship between your fixed cost and the profit. See, what happens is, first of all, you make a sales. From your sales, first of all, variable cost is what you lose, right? Then what is left is your contribution. From your contribution, you remove your fixed cost, the portion which is fixed. What you get is profit. That means if the organization can cover its fixed cost properly after variable, if it can cover its fixed cost, then is only the situation that will arise that will lead to more profit. Otherwise, if you're not able to cover this much amount, then you are facing a loss, right? So it impacts a business sensitivity to sales volume changes and also earning before interest and tax. So let's talk about it further, everyone. First of all, please share the session. And everyone at the same time, I hope you're preparing well for your examination. If you haven't done it yet, then definitely go ahead and check out our courses right away. Our courses are available at a good amount of discount for all of you. So please go ahead and check it out right away. Anji, talking about this particular area altogether, what are we talking about, everyone? Understanding the operating leverage. What do you mean by the term operating leverage? Operating leverage is basically just making your present working a better working. Okay? So when we say present working a better working, how does it work? You want that at least you can cover your fixed cost properly, and I wish that I can at least lower my fixed cost. I would like to reduce my fixed cost. Wholesalers with low fixed cost will always have greater profit. How? From your sales. Once you remove your variable cost, what you left is your contribution. Okay? Then you remove your fixed cost. If your fixed cost is higher, then most of the money is exhausted. What you're left with is a profit which is very much limited, isn't it? While in this case, high fixed cost, what happens is our fixed cost is quite high. What will happen in this case? Your fixed cost is very high, then your profit will fall. When your fixed cost is low, then your profit will be higher. That is the specific scenario. That means there is an opposite relationship between your fixed cost and your profit. Higher the fixed cost, lower will be the profit, because it will take a lot of efforts to cover that particular expense. Based upon this, in terms of degree of operating leverage, there are certain formulas. Is this particular formula wala area very important, super important, normally asked in the examination a lot? Okay, look at this part. They say degree of operating leverage. Degree of operating leverage means that we are talking about change in business. The degree of measures the business sensitivity to change in sales volume. That means you're talking about your percentage change in your EBIT upon percentage change in sales. How does it work, everyone? You take your change in EBIT, earning before interest and tax, divided by EBIT, divided by, this is your change in sales divided by previous sales. We are not taking current but previous sales. Okay, so percentage change in EBIT divided by percentage change in sales. What is the defined formula in this case? See, Do you remember? In terms of financial leverage, what was the formula? That was EBIT upon EBT. In this case, what happens is we keep contri above and EBIT below. Contribution divided by earning before interest and tax. What was the formula for contribution, everyone? Contribution is from sales, remove your variable cost. This will give you the contribution. Everybody take a screenshot if you are just watching this YouTube channel, and if you are taking up our courses as well, then definitely go ahead and download the specific era, because this compilation is going to help you a lot in understanding things. Now, let's do a specific question there. You are given a sales. From this, you remove your variable cost, you're left with contribution. Remove your fixed cost, you are left with your EBIT. The formula is contribution divided by EBIT. What's your contribution, everyone? Your contribution is 20,000 divided by earning before interest and taxes, 5,000. So what would be your operating leverage? It is going to be 5 fours are 20. That means in this case, whatever money we are putting in the business is basically what? At the current level of operations, when we are trying to improve our operations there. So in this case, whatever contribution we are having, this shows that we are having sufficient money to cover our fixed cost. Higher contribution means you can cover your fixed cost properly. But what if your fixed cost cannot be covered properly? That would be a problem. Now, when it is not covered properly, then you will face losses. Then, now, what's the implications of operating leverage? Number one is profit volatility. See, always remember, if your operating leverage is high, then high operating leverage can lead to greater profit fluctuations. When your volatility is high, at that point of time, profit fluctuation will also be higher. Risk assessment. Always remember, if you are not able to cover your profits properly, it will lead to major losses. You know, risk assessment. Always remember, if you are able to assess your risk, you will always take loans accordingly. If you take a lot of loans, obviously you won't be able to cover it, and that will lead to a lot of financial pressure on the organization. So this helps you to find out that there are certain risks and you cannot close your eyes on the risks. Then comes strategic planning, guides decisions on cost structure and pricing structure. That means we are just looking at both the areas. Can we decrease our cost, and at the same time, can we control our pricing? Then, everyone, based upon this, we are looking at operating leverage. In terms of operating leverage, what's the balancing operating leverage? Always remember, if fixed cost is too high, that will lead to a lot of pressure on the organization, ultimately reducing your profits. And at the same time, the most important area is risk management, everyone. Understanding operating leverage helps in managing business risks effectively. Always remember, you can manage your risks only when you have calculated those risks properly. If you were not calculating it properly, the situation can definitely fall apart for you, isn't it? So, this is the topic of operating leverage. I hope this particular topic is all clear to you. Huh? So we are done with the formulas of operating leverage and financial leverage, right? Let's do a specific question from the book itself, everyone. Calculate the degree of financial leverage when the company sells 1000 units. They are given that you are selling 1000 units. Your sales is 50 rupees. Variable cost is 30 rupees per unit. That means you are having a contribution per unit as 20 into 1000. Total contribution for this organization is 20,000. From this, remove your fixed cost. Always remember, variable cost is ideally given per unit, but fixed cost is never given per unit. This is given in total. This is where we have 15,000. This means my EBIT, earning before interest and tax, is 5,000. So that means you have to take contribution divided by earning before interest and tax, and that is where we'll be talking about this 20,000 divided by 5,000. Everybody, this was the specific question. This is a specific question from our book itself. I hope you are absolutely clear about these questions. Acha, this is where I end my session on operating leverage. I hope this session was helpful. If it was, then don't forget to like it, everyone. Thank you so much for being there. I'll be meeting you in the next important session of these 10 minutes concept shows. Stay with us, prepare well for your ABFM examination. Thank you. Bye bye, everyone.